Well, let me start off my name is Matthew Coyle. I am with Team Coyle at Compass. I'm here with my partner, Ying Coyle. We're local real estate agents that help people buy and sell real estate throughout Massachusetts. And today we have a special guest with us, Patty Flowers. Patty, how you doing today?
Hi, great. Thanks all for having me.
Great. Well, thanks for coming. And Patty is an expert in 1031 exchanges. So we are going to ask her a lot of questions about the subject and hopefully answer some of the questions you've given us from time to time.
Yes, no, for sure.
Yeah, I'm very excited to have you here, Patty, finally.
Thank you. I know it. I'm happy to be here. And I think this is such a great venue to talk about 1031 exchanges. There's a lot of misconceptions. People don't even know it exists. So this will be a great forum for that.
Exist too. If the people in Washington have their way.
I know. We're working hard at that to save 1031.
So, Patty, just to start off, why don't you just tell everyone about yourself, what you do, where you work, and how long you've been doing 1031 exchanges?
Sure. So I'm Patty Flowers. I work for a company called Investment Property Exchange, or IPX is our short name, and we're qualified intermediary. So 1031 is a section of the tax code that says you sell investment property, you can save on paying the capital gains tax to buy other property, and they say you need a neutral third party. So that's us. We're the neutral third party. IPX is national. We're the largest and probably, I think, the oldest 1031 exchange company in the country. Yeah, we've been in business for over almost 40 years, I think. And I'm based in Boston. I'm part of the Northeast region, and I've been doing this for over 20.
Yeah,
so a long time.
It has been a long time. When I was looking for a QI, and I got two attorneys, both recommended you, which is very impressive.
That's so nice. Yeah. I love to hear that. Thank you.
Well, that's great. And QI stands for Qualified Intermediary.
Yes.
Which Patty is, correct?
Yes. Yep.
So, Patty, why don't we just start off with the basics for people who aren't really familiar with 1031? Let's define it first.
Sure.
Just get a brief description of what it is.
Of course. Yeah. So 1031 is actually a section of the tax code. And what that says is if you're selling investment property, and it can be any type, we'll talk about the different types that qualify. But when you're selling investment property, normally you'd have to pay 25, 30% in taxes, and even upwards of 35%, depending on what state you're selling in or live in. So the taxes can actually be deferred, set aside. If you set your sale up as an exchange prior to closing, you use a neutral third party, which is us, the QI, and you go on and buy other investment property. So it allows you to take that 25 or 30%. I mean, that could be $30,000, $50,000, $100,000.
Money there.
Yeah, and you get to actually keep that money. Take it with you and reinvest it. So you get to keep your equity. It's a huge benefit.
And the key is, from a tax basis, it's a deferred tax. It's not exempt.
Exactly. So people call it a tax-free exchange and maybe tax-free that year, but it could be, you could owe it down the road. And sometimes it is tax-free in the end. There's a couple circumstances in estate planning where it can be.
Right.
But really, it's a deferral.
Yep. That's why we want to give a little bit tip in the end. So stay tuned to the end of the interview. Patty gonna give us some tips how you can make this investment property really tax free.
Sure.
Entirely. So
yes.
But the key to making this transaction, Patty, is to have a third party like yourself, a qualified intermediary involved in the process. Otherwise, I'm asking, not telling. Otherwise, the IRS will not recognize it as a 1031 exchange.
Correct. Yeah. The number one reason you need an intermediary for the exchange is because the IRS says the seller, the taxpayer, or anyone who works for them, their realtor, their broker, advisor, attorney, CPA, cannot touch the money in between your sale and your purchase. So if you go to a sale closing, you take your money and you walk out the door, it's wired to your bank account, it's too late to do an exchange.
Okay.
Yeah, you absolutely have to be set up prior to the sale closing with an intermediary.
Okay.
Yeah, that's what I was talking to the buyers before they sell their property. They should at least talk to a QI and or real estate agent who knows about it, and because you might put some wording in your PNS, right, in your contract when you sell it. See, this property
Right.
may be for 1031 exchange, so you can put the money aside. Nobody can touch it.
Right, exactly. I mean, the worst phone call I get is when they're calling and they want to do an exchange and they said, I've closed. And I say, well, closed like signed an agreement, or closed like went to the closing, took the money. And when they've taken the money, it's too late.
Too
Even
late,
if it's
yeah.
that afternoon, the next day, it's too late. And that's a heartbreaking call.
Right. Okay. So why don't we just talk about what types of investments do qualify for this type of exchange?
Sure. So, I mean, they talk about it as a like kind exchange, is what the term is in the tax code. But like kind is pretty misleading. It's actually very, very flexible. So you can have multifamily rentals, single family rentals, condominiums, commercial buildings, apartment buildings, retail, industrial, raw land even counts.
So anything really that has a productive use in terms of generating income or an investment type property.
Exactly. So I would say it cannot be your primary residence,
Okay.
and it cannot be a straight second home. So anything that's personal use and enjoyment is what they say, does not qualify. But otherwise, you can mix and match types of properties as well. So it's very flexible.
Oh, okay, good.
So you mean you can mix up with residential, commercial, raw land,
Mm-hmm.
everything?
Yeah. So like I just recently had a client who had a commercial building around $1.2 million, and he sold that property. He bought another commercial building that he was using around maybe about $900,000. So he had a little bit of a delta left. And so he used the other money and he bought a condominium that's going to be a rental. So he bought some commercial and some residential rental. So he mixed and matched.
So when we talk about being tax deferred, I always like to clarify, does that apply to both federal and state, or is it different for, let's just focus on Massachusetts.
Yes.
Does
Yes,
honor that?
Massachusetts, in all of New England, covers federal and state. So normally what happens if you sold an investment property, you have a number of taxes to pay. So sometimes you'll hear advisors say, oh, it's just 15%, but that's not really true.
Right.
The federal capital gains tax is either 15 or 20%,
Correct.
which is
Based on-
obviously
based on
deferred.
income, right? Exactly.
Based on your income.
Right.
Massachusetts state capital gains tax right now is 5%. But then you've been taking depreciation each year on your property. That's a great idea. That's a write-off each year. But when you sell the property outright,
There's recapture
the
tax on
recap,
it.
yes, is 25%.
Yeah.
So you have that. And then if you have all those taxes, you might fall into that, the Obamacare healthcare tax, which is a 3.8% tax additional if you made a certain amount of investment income 1 year.
Right.
So it bumps you up pretty quickly. So all Massachusetts and all of New England, definitely federal and state is allowed to do the 1031 exchange.
Yeah. But the key here, what we talked about earlier, it's deferred. It's not free.
Exactly. It's a
Tax-free.
tax deferred exchange. So what you would have paid, as long as you follow all the rules in the middle, whatever you would have paid in taxes, you get to keep that equity and roll it on. But your basis is still reported the same. Behind the scenes, the gain was calculated. So it's recognized versus realized. So you calculate the gain that year you sell on your tax return, but you don't have to pay it because you did an exchange.
Right.
So it's sitting on paper following you from property to property as you exchange.
And I guess the risk could be is if capital gains tax goes up from its current levels, state and federal, you could be paying higher tax
later on. So a lot of people will exchange into something. A few years later, they might do another exchange, et cetera. But if at any time you decide to sell outright and be done,
right.
then the taxes are due, and that is the risk. You're right.
Right. Okay. And then, going back to qualified intermediary, I thought I read somewhere that if you have an LLC, you can do that as well. You can facilitate this type of transaction. Am I misunderstanding that, or is that wrong?
Do you mean LLCs can do 1031 exchanges?
Yeah.
Any entity can do an exchange. So you
Okay.
can be a trust or a partnership. You can be an individual. Any entity that's on title can do an exchange. The key is really, they call it vesting. So the key is whatever entity is the seller, that same tax entity is supposed to be the buyer on the other side in an exchange.
Okay.
But LLCs can sell and buy, partnerships, individuals, trusts.
But in that type of situation, I would still need a qualified intermediary. That's, I guess, what I'm asking.
Oh, absolutely. You always need a qualified
So-
intermediary no matter what.
I apologize. What I was asking, can an LLC replace what you do, as an example?
No.
Okay. All right. So your role is, in order to get IRS favorable treatment on this transaction, is critical.
Yes,
Okay.
absolutely.
Okay.
Yes. No, you have to have a neutral third party as an intermediary to do the exchange.
Okay.
Yes.
Okay. So, let's talk about time requirements for this. It's, I think, 180 days, 6 months, and
45 days to identify the property, replacement property.
Yeah, it's. I have lots of questions emanating from this, and there might be. I know there's reverse 1031s too, which I want to talk about later. But walk us through how that works. The 45 days versus the 180 days, like maybe an example.
Sure. So the timelines are incredibly strict, and especially in certain markets like now where properties are moving so fast, it's even more critical. So you can sign a purchase and sale agreement at any time for your sale or your purchase in an exchange, but it's the closing dates that we go off of. So the sale closing date on the settlement statement or CD, Alta, whatever you have, that sale closing date starts the clock. And from there, you have 45 calendar days to identify to us in writing. We have a form, an identification statement, what property or properties you plan to purchase.
That's in a traditional 1031.
Yes, this is a regular forward exchange, they call it.
Right.
Forward exchange is the regular. And so the clock starts, you have 180 days total in the exchange. So you have the first 45 to identify or list to us what you plan to buy.
Mm-hmm.
You have an additional 135 to close. So for a total of 180.
So in this market, that obviously poses a problem or a challenge.
A big challenge.
There's no inventory, and a lot of people want to sell, but they can't find a place to live.
Right.
And with this, it's even, you're in the same boat.
It's a lot of pressure.
Yeah.
So
can we put this one to a example? Like if your previous property, the one you sell, closed on January 1st,
mm-hmm.
and then you have to by February 15th, let's say just for roughly.
You have to list it, identify it.
Mm-hmm. Then by July 1st, I know there's probably 31 days.
That's okay.
By that calendar day, you have to close the replacement property.
Absolutely.
Okay.
So the closing date's usually easier to meet, even in commercial properties. That the closing date's not as much of a concern, but the 45 days is crucial. So difficult. Yeah. And in, the regulations have been in place for decades.
Right.
I mean, 1031 exchanges is 100 years old. 1921, it started in the tax code. And then, of course, it was very quiet then. And then over the years, but mostly in the 89, 91 regulations, some other years, there was some big tax regulations. They've refined 1031. And when they put those timelines in, back then it wasn't as much of a pressure situation. Real estate moved along, but you could make an offer, you'd look at 2 or 3 places, you go back and forth, you had some time. Right? You don't really have time right now as much in the market. And with the internet and everything online, it moves faster. So what I try to suggest to people is, as you're getting your property ready to sell, mm-hmm. you should also be thinking about and starting to look for what you plan to purchase. Even though you might not be able to pull the trigger on a purchase quite yet, I think get an idea, have somebody out there looking for you, kind of juggle both at the same time a little bit to get a feel so you're more ready.
So in the first 45 days, this is a crucial point, is you have to specifically identify a property or several properties. Is that what it is?
Yes, so it has to be site specific, which means the exact property address.
Right.
So you can't even say a condo in Marina Bay. You have to say unit number such and such is one identification.
And how many identifications are you allowed in that first 45 days?
The most common rule is the 3 property rule.
Okay.
You
Yeah.
can identify up to 3 properties of any value. There is a second rule that is utilized a little bit. It's called the 200% rule.
Mhm.
And in the 200% rule, you can identify 4 or more properties, but the trick is you have to also list their fair market value or list price. And when you total those up, those 4 or more properties that you're identifying cannot exceed twice what you sold. So, for example, if you sold something for $1 million
Correct.
and you wanted to identify 1 or 2 or 3 properties, the sky's the limit. It can be any value.
Right.
But if you are selling for $1 million and you want to list 4 or 5 properties, even though you may only buy 1, but you want to list some options, when you list 4 or 5, you list the dollar values, and those cannot exceed $2 million, twice what you sold.
Gotcha.
And that's tricky.
is
So
tricky.
that 200% rule really works best if you're selling a bigger one and buying 2 or 3 smaller ones.
Gotcha.
Mhm.
Makes a lot of sense.
And
Okay.
there's also a 95% rule. So there are 3 rules. You can choose either one, right?
Yes.
When you do exchange. Can you talk about a little bit 95? I know that one was not really being used that much.
That's true.
Yeah.
Right. It's not that common. So the third rule is the 95% rule. And what that says is if you identify 4 or more properties, and when you total them up, they're more than twice what you sold, you have to purchase and close on 95% of the list, which really means everything.
Everything. Like
Yeah.
you switch
So-
to 6 properties, you have to buy 6
All
of
of them. Yes. And like who knows who's, overseeing that? Like it's not up to us. If you can't close on all 6 by day 180, we're not going to do anything, but it's just in the IRS's eyes, you failed your exchange. It's a silly rule to me. I feel like they threw it in at midnight because they didn't have anything else to say. And that was just going to put a big period on it, and send it
Yeah.
off. But it's not that common. The most times we see that is if someone's selling and they might be buying a portfolio of properties from someone.
Mhm.
And so it's pretty guaranteed. You're buying 6 or 7 or 8 properties at this value, and it's definitely going to close.
So if I have a house today, let's say it's January 1st, right? When do I want to contact someone like you? If I want to sell my house, do I want to have it sold before in other words, under contract, under agreement before I contact you? Or do I say, hey, Patty, I'm going to sell my house. I'm going to start the process now. Let's go.
Mm-hmm. So I get calls both ways. My preference is I feel like if you're thinking about an exchange, you should call because I have a lot of polite questions that I ask on the
Sure.
first phone call
Okay.
and just trying to get a handle. There's a lot of misunderstandings and misconceptions. So I just would prefer to be able to tell you, hey, you should do this. You should do this. You have this choice, this choice. You definitely cannot do that. And kind of get people's mindset going because by the time you can certainly call me after you signed a purchase and sale agreement with a buyer, but you've already kind of have wheels in motion. And if you're going in the wrong direction, now you have to backtrack.
Yeah, no, I think that makes a lot of sense. But what I'm trying to get is the clock starts ticking.
Oh,
So when
yeah.
I
So
can talk to you beforehand, but should I I don't know, make it officially January 1st if I'm not ready to sell yet, or should I wait till I have something on the agreement and then say, Patty, after talking to you, let's go? What do you
So
recommend?
officially we cannot start until you have a signed purchase and sale agreement
Okay,
for the
okay,
sale.
all right, that's
Yes,
great.
I'm sorry. Yep.
Okay,
So officially, once you have a purchase and sale agreement signed,
that's when the
then
clock
you would,
starts.
that's when you want to get me involved because we take that information and a copy of that to open the exchange account.
Do I have any time, like a week after I sign it, or should I do it simultaneously?
You have time. So I'm really worrying about the closing date.
Right.
So I feel like you should let me know. Well, I always say right after the sales agreement is signed, just
Right.
because that's helpful. But, we need a couple weeks 2 or 3 weeks notice.
Right.
So we have to be in place 2 or 3 weeks before the sale can close. That's really the wish list.
Mhm.
I'm sure, people have called, the day before, the week before, what have you. But there's no set timeline. After you sign the P&S, you could wait and then call me. But it does take a week or 2 of back and forth and setting up and documentation and
Talk to the attorneys.
yeah,
too,
we have to work with the
yeah.
attorneys and trying to gather everything takes a bit of time.
So what happens if I get a signed P&S, right? I engage you. The clock starts ticking. and my buyer has a mortgage contingency in it, and then for some reason they get denied.
Mm-hmm.
What is that? What situation am I in now? Do I still? I guess I have to find another buyer, so the clock still keeps ticking.
So there's no clock until the sale closing date. So if you have a signed P&S with a buyer and you're going along and then they fail for whatever reason,
Right.
you're not going to have a sale closing. So there's no exchange.
Okay.
So anything that happens prior to the sale closing, which cancels the sale or slows it down, does not affect us at all.
So the clock starts ticking on the close date of the sale.
Property.
Okay.
Yeah.
All right. Okay.
Mm-hmm.
So then I have 180 days from that.
Yes.
Okay, got
Yep.
it.
And
Okay.
actually, the
Okay,
most
all right.
important, I think, I have a question from my client is, what if the property you purchased has problem, cannot close, right? You sell property A, you're purchasing property B for replacement, but before property B closed, there's something happened. Maybe the seller had, in this case, the seller don't want to sell anymore.
Right.
So what the investor gonna do?
Yes, that's a problem. So if your sale closes and goes fine, you have the 45 days. So you may only identify one property thinking it's already under agreement. I have a deal with the seller. I'm fine. But if you identify one property and you go past day 45, and then that purchase falls through for any reason, the IRS does not give you any opportunity to go back and identify something else.
Wow.
You're done. Yeah, your exchange is over. So that's the benefit of identifying number 2 or number 3, even though they may not be around.
Right.
I try to tell people, if you're a little bit concerned about this is the one you want to buy, but you're a little bit concerned that it might not close, maybe around day 40 or 41, be looking for other properties that are coming on the market or just being out there. And maybe list number 2 and number 3 as one of those. So in case it falls through, you might have a backup still available.
Exactly.
Are you able to switch the properties? Like, can I make a selection and then change my mind?
Only within the 45-day window.
Yeah, that's fine though, but I
Yes,
have that flexibility.
absolutely.
Okay, good.
Within the
Okay.
45-day window, you can
Okay.
add and subtract any way you want. But once you get to day 45, you're locked.
Okay, so let's say continuing this scenario, I sold my house. The clock's ticking. Let's say it sold on January 1st. Keep it simple. I have 180 days. Say June 30th is when I have to have that purchase completed and closed. Let's say it's delayed by 1 day. I lose the exchange.
Yes.
Okay, so it's really that inflexible. It's
very inflexible, correct, yes. If you have got to get it closed. So if there's we've had a lot of closings before where they say they can't close and we're like, you have to close. And they
Right.
do figure it out. Maybe there's a little holdback somewhere,
Yeah,
or if it was
exactly.
an environmental question or something, or a tax, but you have to close, meaning have a settlement statement. The money is wired in and you've taken title
Gotcha.
by day 180. So the settlement statement, executed settlement statement, indeed are that day 180.
And all the proceeds of that and the disbursements will go through your organization, correct?
That's right. That's right. So when the sale closes, the reason we need some of the front time is to get in touch with the closing attorneys and title companies. And so what they'll do is the closing goes completely as normal. They pay the real estate commissions and closing costs and everything. But at the bottom line, that net proceeds back to seller, instead of going to the seller, instead gets wired to IPX for the exchange.
Right.
We hold it. We can pay the deposit from what we're holding.
Right.
So
yeah,
as
that's
well,
what we did this time.
yeah.
Yeah.
And then otherwise we have all the money ready and we get wire right into the purchase closing.
Okay.
And the buyer on the other side, like property B buyer, they don't even need to know where the money come from, right? Generally,
That's
they don't
seller.
care.
Right, the seller of the property you're buying.
Yes, the seller of the property. Yes, the seller, exactly. Yeah, they don't even need to care about.
Right.
if
And
they-
it should not affect them at all. A 1031 exchange should never really affects the other side. It doesn't hurt the opposite party think people get a little nervous sometimes when they hear IRS and tax and what am I getting involved in? But it really has nothing to do with them. It's really just where money is sitting.
Right.
It's sitting in a type of escrow account with us instead of sitting at the client's bank account. So all the paperwork and everything is only for that exchanger and does not affect the other side.
Okay. Going on with an example, let's say that I bought my house at $500,000 and I'm selling for $1 million. All right. And now I want to do that 1031 exchange. And let's say I buy a house that's $800,000. Okay. So I had $1 million. Let's assume everything's cash. I have no mortgage. Keep it simple for now.
Okay.
Okay. So I'm going to get $1 million of proceeds, which you'll collect. And then I'm going to buy this. I use that to buy a house at $800,000. So I have a $200,000 gap there.
You're talking about the boot.
Okay. So
The boot, the kick in the pants.
Here you go.
head of her class. So what happens with that $200,000?
So you have a couple choices. You could go on and buy a second replacement property with the money if you wanted to. You could identify and buy a second. If not, after the purchase closes and you have not identified to purchase anything else, the exchange will close out. We will return the $200,000 to the client, and that is what they call boot. And so you'll wind up paying capital gains tax on the $200,000.
Correct, okay.
So that's considered a partial exchange.
Okay, but you're saying the way around that is if I took that $200,000, but I'd probably have to add more money to it because
Right.
you're not gonna
What
get
are you going to buy?
$200,000 in the house, right? Exactly. But I could defer that tax if I were able to find another property to invest in.
Right, exactly. And so sometimes people will take the money if they're going to buy two properties and they'll say, oh, send $400,000 to this one and send $600,000 to that one. And they might get a loan for one of them too. So you can always buy greater. And as long as you use all the cash,
Right.
in this example, it's an all cash sale anyway.
Right.
But so you can mix and match the funds any way you want and send them to two closings, and whatever's left over by day 180, we're going to return to the client and they're going to pay the taxes.
Okay, good. So that's probably an easy transaction because it's all cash. Now you have debt, let's say, but most
Right.
investors are going to borrow because
Exactly.
of the leverage effect. So how does the boot work with that?
Yeah, so the key in the exchange for the dollar value rules, if you're selling property for $1 million and you're going to pay off a $200,000 mortgage, you're going to have $800,000 left, and
Right.
we won't worry about the closing
Yeah,
costs.
right.
So at the end of the closing, the $800,000 would get wired to us. The goal for purchasing is to use all $800,000 and match the $200,000 debt with either new debt or new cash. And so sometimes when people are buying, they want to only put so much cash in, 25% or 30% in cash and get a higher debt,
Right.
but they can't do that in the exchange because they need to use all their cash. So they put in all their cash and just get financing for the difference.
And then if they do, instead of using let's say they want to get a 25% loan, 25% of $1 million, say $250,000 versus $200,000, that $50,000 would be taxed.
Correct. So exactly, because that would be extra cash that they
Cash
did
of
not
another
use.
$50,000. Yeah, exactly.
Right.
Okay. So it's very important how you structure this.
Right. And that's what, we want. That's part of those early conversations, to try to have with people. So they have to think a little bit because the lenders, of course, will say, oh, we'll loan you up to this amount, loan to value. And in the exchange, that's not always the best decision.
Yeah, and I'm sure most people you deal with in these transactions are using some form of debt financing.
Yes. Yep. I mean, there's a mix of both.
Yeah.
So, but plenty of people have, the majority certainly have some kind of financing in place.
Okay.
And another question I always get is, can foreigner do the 1031 exchange with maybe no green card, no citizenship? Can they do the same?
Mm-hmm. So if you are not a U.S. taxpayer, you have to follow the federal guidelines called FIRPTA, FIRPTA. And there's very specific guidelines. You actually have to apply for what they call an ITIN.
Right.
And so there's a few things that you have to do. So if you do not have if you don't have a U.S. federal tax ID number, either an EIN or a Social Security TIN, you have to apply for one before you can sell and do an exchange. One of the points about a 1031 in the intermediary is we're opening bank accounts. So we're opening a savings, like an escrow account, for each person's exchange. So the money is really their money, but we're managing it because the IRS says so.
Sure.
So we have to open a bank account under somebody's name and ID. So the FIRPTA you definitely need some planning time if you're a foreign person selling U.S. property and plan to do an exchange. Not everyone has those FIRPTA identifications ahead of time. So that does take some time. And there's only certain attorneys and tax advisors that really understand it.
That's exactly right.
Yeah.
Like the withholding and tax, how to apply to IRS, everything. Yeah, it's very different.
Right, because what's going to happen is that at closing, when you sell, whether it's an exchange or not, they want to withhold 15% at closing under the FIRPTA guidelines. And so you have to apply ahead of time to get that waived. And so you can imagine applying to something at the federal government level. It goes into a box, into a deep hole, and you have to just sit and wait. And it could take 90 days, 120 days.
COVID,
right. So the one, there's a couple little suggestions we have when people are doing that. But if you're a foreign person selling, you do need some extra time prior to sale closing to get that all in place.
Okay.
The good thing is you can do it. But
Yes.
Timing and
We have a number of clients who are foreign status who sell and buy as a 1031 exchange. It definitely can be done.
Great.
So we spent a lot of time talking about traditional or the forward exchange. I think that's the right term. Let's talk about the reverse exchange. And I'm bringing that up because I think in this market it's probably more apropos, given that there's no inventory of houses out there. It's harder to find a house, that replacement house, I guess. So how does that work?
Yeah, so a reverse exchange is much different in structure and preparation than a forward. And our reverse division has been busier than ever, for sure.
Oh, okay.
Yep, you're absolutely right. What happens is that a reverse exchange is when you have to buy the new property before you've sold the other.
Okay.
And it's not just signing the purchase and sale agreements, it's the closing dates again, right? So you could sign a P&S for what you're selling, sign a purchase and sale agreement for what you're buying, and still have a forward exchange where you sell first and buy second.
Right.
And so I've seen more than ever, just as an aside, people have what they're selling and what they're buying by the time they call us. They already kind of have both in place. But several problems come up, right? So either, you're afraid to sell your house because you're not going to find what you want in the timeline, as you said,
Right.
and you want to buy first, or you were ready for a forward exchange. Something happens, your buyer backs out, just in your example you mentioned earlier, the buyer backs out, and now you have this purchase closing that's got to go 2 weeks from now, and now you have to go back to the drawing board with your sale. So all of a sudden you were doing a forward exchange, and now it has to switch to a reverse. You can do that. It's a long play term. We need about 2 or 3 weeks notice at least.
Is that what
to get set up?
Does this clock start? How does the clock work?
Yeah. So what happens is in a reverse exchange, the taxpayer, just kind of generally, is not able to be on title to what you're selling and what you're buying at the same time. So we as the intermediary have to become the title holder. We actually have to set up a single member LLC, like set up an entity, and we physically take title at the closing. We buy the property with the client's money.
Wow.
We park it. It's called a parking transaction. We're parking the property for them and holding it until they can get their other one sold.
Gotcha.
So as you can imagine, if we're taking title to something, that's a big deal, right? Yeah. And we have to be able to review title commitments and environmental reports and things like that. Our parent company is Fortune 500, Fidelity National Financial. It's the largest real estate services company in the country. and they have concerns because then it's on their books, this property. So what happens is lenders won't always accept reverse exchanges. A regular lenders who just sell in the secondary market, they want to be able to put that loan in a package and send it out.
Right.
It really has to sit in portfolio for at least 6 months. It still have 180 days even in reverse. So not all lenders will allow reverse exchanges either.
That's interesting.
So that takes a lot of front time. So not only do we need a couple weeks to get it structured, if there's a lender involved, because my first question is, how are you going to get the money to buy the new one when you haven't sold the other?
Right.
And if you have all cash or you're getting it from somewhere else, that's great. If you have to get financing from an institution, they have to approve the reverse exchange because we're involved in title.
That's an important point you made. Is most lenders don't like to hold these mortgages; they package them off and sell them off. So, and I can see with the reverse, it forces them to hold it for I guess the 180 days.
Right, or less if it takes time. Like some reverses, a lot of them are done within a month or two, but they have to be able to either have a commercial loan or some type of portfolio product where it can sit in-house. And then that way, they're still making money on it and they still have financing. It's guaranteed by the client, by the borrower. So it has nothing really to do with our company or our financial situation. It still is all about the borrower.
Right.
But we're just an additional player now in the process of the purchase.
Correct. Okay. So I guess you probably have a short list of institutions that will accommodate these types of reverse.
Yes. Yep. We're always looking if groups are willing to do it. We're happy to have them on board. And it does take some time. I think sometimes a lender will say, "Oh, we won't do that," and then I can get on the phone and kind of explain how it works. And sometimes they can get comfortable with it because they certainly want to loan to their clients.
Sure. But I guess the rates might be higher too.
I believe they are.
There's less competition or less interest in that area.
And I think it might be because it's a short-term rate, and then when it converts back at the end of the exchange, it can go back to a normal loan and be sold sold off as a package, or it can convert back.
Oh, okay.
So I think it's almost, I equate it to maybe like a construction loan.
Like a bridge loan, maybe?
Yeah, a bridge loan and construction loan where there's a temporary plan for 6 months or less, and then it converts to a regular loan after that.
Okay, that's very interesting. So with any law, there's always loopholes. So I'm going to come back to the primary residence. Okay. So, there's a lot of people that have looked at it. It's been around 100 years. A lot of people have looked at this a lot longer than I have. I'm sure you have as well. And I'm sure you've seen lots of different variations of how people try and work around the rules. But, on the surface of it, it says very clearly that primary residents are excluded from this. And I'm not talking about, we'll talk about this in a second, Section 121. That's different.
That's correct.
That's different. But for this purposes, are there ways to get around this and this, it must be an investment type property? And I've asked the question, I'll let you answer, but one of the things I thought about, which may or may not work, is what if I hired a management company to rent out my property and I could be the renter to it? That would be an investment property, but does that qualify or is that breaking the rules? Or
it's breaking the rules.
Okay.
No. You cannot rent from yourself. That's probably the bottom line. The primary purpose of the property is for investment or income use. And so at face value, as an intermediary, we don't monitor. Once the exchange is over, we don't monitor who you're renting to, what have you. It's really between the taxpayer and the accountant and how they're handling it. So the goal is to be able to, unless it's raw land, obviously, the goal is to be able to rent, and you're going to show rental income and take expenses and depreciation and things on your tax return every year. And so when you're buying a personal use property, the IRS doesn't consider that investment.
Right.
And so when you look at who's renting it, you can rent to a family member, but it has to be a year-round rental. not short term. So like we
Does it
have,
have to be a full year, or can it be 50 weeks as an example?
I guess there's some not exact regulation on it,
Yeah, right.
but most advisors have come to the understanding that it has to be a full year-round rental,
Okay.
where if you treat them like a stranger. Maybe you're renting
Arm's
to
length,
your
that's
son,
right.
you know, and their college friends are all living there or something for going to college or what have you, or you bought an apartment, you know, and someone relative is living there. It's supposed to be an arm's length transaction. You have a lease in place, security deposits, fair market value rent,
Right.
as if
Makes
you
sense.
were renting to a stranger. So there are not very many loopholes for trying to use a primary residence as a 1031. It's just not acceptable, and I don't think many tax advisors would sign off on it.
Right.
It's
Okay.
just not. You have to have a primary residence. You know, usually on your tax return, you have a residence, and then you have other properties that you declare on your Schedule E that's rental.
Now, would that apply to vacation homes too, or the loopholes
Second
for
homes,
doing that?
yeah.
Because that's not a primary residence.
Right. So vacation and second homes actually have their own particular regulations, and they were firmed up in 2008. So what happens is that people certainly consider their vacation and second home an investment to them. You know, they're using their extra money, they're
Sure.
taking care of it and what have you. So it's beautiful. They love going there. But the IRS terms it personal use and enjoyment. So if you and your family are going there, relatives, you might have friends and they give you $100 or fill the refrigerator or something, like that doesn't count
Right.
as rental. So unfortunately, vacation and second homes that are personal use do not qualify. The regulations say you have to rent the property at least 14 days per year in each of the last 2 years before you sell. So that seems easy to do, right? You could rent
Right.
something for 2
Yeah,
weeks.
2 weeks.
Well, you have to declare it. A lot of people, if they only rent for a few weeks, never declare it. And you don't have to under 14 days, but it has to be on your tax return.
Right.
Like you want to have a rental history.
Right.
Okay.
And if you haven't been declaring it and then you say, oh yeah, I did that, now you're opening up a bigger can of worms than the exchange,
Right.
right?
Right.
So it also says not only do you have to rent for 14 days per year, but you cannot use it personally more than 14 days a year or 10% of the total time rented.
Right.
So it's tricky. If you have a house at the Cape or up in the mountains or ski country or what have you, I mean, you might only rent it. Even if you do rent it, you might only rent it 6, 8, 10 weeks a year. Are you going there all the other times? Are you going on their holidays? Now, maybe if it's somewhere seasonal, it's closed up and you're not going there.
Yeah, less than 2 weeks is
Yeah,
short time,
2 weeks.
especially
And maintenance
time.
days don't count in your 2 weeks of personal use.
Right.
But the IRS considers it very black and white, and the rest of the country does not. So I think, we try to send out the rules and let them decide if they qualify for themselves. And you can convert its use. Some people have had a property that's been a family vacation home for 10 years, and now they never go there anymore. The kids are grown, they're going other places. So now they could change it over to a rental, rent it for 2 years, and then sell it as a 1031 exchange.
It's got to be 2 years, though.
2 years. Yep, that you have to have at least those 14 days or more in each of those 2 years before you sell.
Yeah, and I wasn't suggesting doing anything illegal.
No.
but there's a lot of loopholes and people take advantage of them.
Creative.
Yeah, exactly.
Right.
Exactly.
Yes. Yep. And there are times where, like I said, there's a lot of conversion goes on. You buy something thinking, oh, I'm going to rent it, and then a couple of years later you say, okay, well, we're done here. Let's move into that. Or now we really like it better there at our rental than we do in our own home.
Right.
So there are definitely changes that go on while you own property. And I think that's valid to be able to adjust how you manage your properties.
Okay. 121 exchange. That's for people with primary residence. I think that's the standard deduction you get on capital gains. Is maybe you could just talk about what that is.
Sure. So Section 121 is for primary residences.
Is that part of 1031?
It is not.
Oh,
Nope. It's a different section in the tax code. And they don't actually even call it an exchange because you do not have to go on and buy another primary residence to qualify.
Right.
So really, if you've lived in your property 2 of the last 5 years, as a primary residence.
2 years is very important.
2 years to the day.
Yeah.
Absolutely. I've had clients where they've called us thinking they can do an exchange because they're selling it month 22. And no one said, hey, you should wait till 24
Right.
to get the exclusion. It's hard. So it's very specific. So if you've lived there 2 of the last 5 years, 365 times 2, then when you sell the property, you automatically, you don't have to do anything. You don't use a QI, intermediary, anything. You automatically at tax time get a $250,000 exclusion, tax-free for a single person and $500,000 for a married couple.
And that's tax-free, not tax.
Tax-free, yes, not tax-deferred. And you do not have to go on and buy another primary residence. If you do, you can actually do it again later as well. So it's not a one-time exclusion. You can do it again in your lifetime.
Okay. You know, I had another question. This is kind of I'm a finance guy by heart, so let me ask you this: let's say I bought a house for $500,000 and now it's worth $1 million. Okay, and now I want to do my 1031 exchange. I sell it for $1 million. I identify my 3 properties and do my forward exchange on my 3 properties. That I want to buy. And I buy, and it's all cash to make it simple. I buy $1 million property. Okay, so my $500,000 capital gains is tax deferred for the time being. So, come living in this new home.
But it's a rental.
Oh, that's right. Okay. Oh, so maybe this doesn't apply because all right. Let's continue. This rental I'm getting. Let's say I have it for 5 years, whatever, or greater than 2, and I then sell it and I only make $800,000 for it. What is my capital gains based on?
Mm-hmm.
Based on $500,000 or $300,000?
They work together actually. So when you sell a property, your basis is what you bought it for, and if you made any physical improvements to the property that you can write off with your accountant. So your basis or your adjusted basis is what it is. And so if your basis is, say, $400,000 and then you sell for $1 million, your gain is $600,000. So in 1031, if you do an exchange and you buy for $1 million, your basis of $400,000 follows you to the next property.
Okay.
So now you're renting this for 2 or 3 years and then you sell it at a loss. So now you sell it for $800,000. So you have a gain and then you have a loss, and exactly. So instead of having a gain of 600, now you've lost 200,000 of that. So the basis is following you, and then when you sell outright, it's calculated the gains and losses along the way.
So it's based on that original property that I own.
Yes.
My investment property they own at $400,000 basis or $500,000, depending on what example you want to use. That's my basis, and that's going to survive the life, whatever I stop.
Right. So people will keep exchanging. I have a lot of clients, of course, I've been doing this for a while now, but I have a lot of clients who repeat over the years, and they understand the system, and their goals change, what types of properties. They don't want to manage heavy intensive renters anymore. They want to be kind of more hands-free, but still rental. So they change what they want to own. So yes, so that $400,000. So you're buying and selling. So you might do an exchange. A couple of years later, do another exchange. A couple of years later, exchange and buy 2 properties. So that splits the basis, and then you just keep going on and on. And eventually, if you sell outright, the taxes are due.
So your firm involved in that history of that client, or
no? It's all with your CPA and the accountant.
Okay, so you're just there for the 1031, and then the CPA has to do all the accounting for it.
Exactly, because we're not allowed to be anyone's tax or legal advisor. We need to remain the neutral third party.
Gotcha.
But everybody has their own accountant and CPA tax firm. So they are tracking every year their basis, their expenses, their depreciation taken, and the IRS hopefully only knows you by your tax return. So
hopefully.
Yeah.
Go ahead.
Yeah. Any more questions or?
I think I'm all tapped out. This is a lot of good information. Is there anything we should have asked that we didn't ask, or?
Well, I think, let's see. I know a lot of times people will call. We have a lot of clients who have been living in a property that they also rent. So if you have a multifamily and you live in one unit and you rent other units, you can do a partial exchange with just the rental portion.
Gotcha.
That does seem to be coming up a lot lately. I think just with the values of the properties the way they are, and some people have stayed in their homes for years but rented out part of it. That always qualifies. And
That's a
I,
good point.
I think in a lot of areas they have that type of property.
They call house hacking.
Yes,
So,
yeah.
that part rented out can be used to 1030 exchange.
Yes,
Okay.
yep. And that's like getting the best bang for your buck because it's a partial primary residence sale that's tax-free and a 1031 exchange that's tax deferred.
Perfect.
Right.
Yeah,
Yes, so you get a
that's-
I see that a lot.
That's good.
And that's a good option.
So my original question back then, what is the last possible day I should contact you if let's say I sold my house today? Obviously, I should have talked to you beforehand. I get that.
Yeah.
I think it's good advice. That way
Yeah.
you should just kind of talk through the situation. But do I have a week, 2 weeks? Do I have to call you that day? What's the latest I can call you to be qualified with this 1031 exchange?
Well, I am never going to promote that you can call me the day before.
Okay.
So, because that is not on our wish list.
Yeah, no, I understand.
So, but it's happened, yes. So that is not what we want to do. But,
They
you
get
know,
the special rate, right?
that's right. That's right. So, but I certainly, there's no panic. I think that once you sign the P&S, I try to tell people we need at least 2 or 3 weeks notice.
Okay.
I just think it takes that amount of time for us to gather all the information we need, because not everybody knows all the answers, like who's doing the closing, who's the buyer side. There's a lot of questions to ask. Then they have paperwork to complete with us ahead of
You're not
time.
going to start the clock until after they sell, probably.
The clock starts on the day of the sale closing.
There you go. Right.
Yeah.
Okay. Right.
So I think a couple weeks notice would be perfect.
Right. Give you leeway to work out all the.
Yeah. And I think a lot of times that does happen. People don't even know they can exchange until they're sitting with their attorney or their title company and they're, reviewing the P&S and someone else mentions it to them. And certainly from your perspective, it's a great time to be able to talk to them even before they've gotten a buyer, just to start to put the bug in their ear that they should think about it.
Yeah, I guess like you said, the worst comes to worst. If you do sign up for a 1031 exchange and day 45 comes and you don't have a property to buy, then you just have to pay the tax.
Yeah, and we've had a few clients who haven't. I mean, it's shocking how many clients have made it through, in this market and been able to find something. But we've had a few clients who say they just don't want to buy just to buy, or it's not economically correct for them, or the bidding wars or what have you.
Well,
so
very true in this market.
Right.
So.
Yeah. So sometimes it just doesn't work out. But I think people are upset when they didn't even know they had the choice. So it's nice to be able to have the option and be able to think it through.
Excellent.
Yes.
I think at the beginning we said that there's one tip we're gonna say for the end. That is if you keep doing 1031 exchange, in the end you might be able to not pay tax entirely. So what is the trick for doing that?
Oh, yes. So the little trick. So when you're doing 1031 exchanges, I mentioned you can sell and buy any type. So you might be in commercial properties or multifamilies, but you do see clients who are planning ahead, and as their replacement property, they might buy in an area that they want to retire to or live in. And so when they buy the property that they like personally as well, now it might be a single family rental or a condominium rental or something. And they definitely rent it out for 2 years or 3 years or 5 years. But eventually they'll sell their primary residence, get the $250 or $500 exclusion tax free, and then stop renting the one they have and move into it and make it their primary residence. And so now they're living in their primary residence for the next 5 or 10 years, what have you. When they go to sell that property, they may still owe a little bit of tax from the rental portion, but the majority will be under that Section 121. So they'll get a lot more tax-free because in the end, the last use of the last 5 or 10 years of use of that property was their primary residence.
Right.
Mm-hmm. And then the other thing is that when you do 1031, I'll give you 2 tips. And so the second trick, just to keep in mind, is that when people do exchanges, at the end, if they own property as part of an exchange, they've been deferring the taxes all along.
Right.
When they pass, their heirs get the stepped up basis, which means that $400,000 basis all these years ago, and now you've been selling and buying, and that 400 has been following you. And now, because you've done well in real estate, you might have $1.5 million or $2 million or whatever you have. It doesn't have to be that high, certainly, in this property. And you still have never paid the taxes on it. Well, when you pass, the basis, that 400,000 moves up to the value of this property at the date of your death.
Wow.
So if the value of this property is $1.5 million when you pass away, and it goes through the estate, and this 400 rolls up, if the estate, your kids or whoever, children, grandchildren, sell that property at $1.5 million, they don't have any taxes due for capital gains because they had no gain.
Wow.
If you sold it and then wanted to give them the money, you'd have to pay tax on 1.1 million
Yeah.
and then give them the rest.
It seems like an odd rule to include in the I guess the law, but
Yeah.
it works in our favor, I guess. But
Yeah.
I
Well,
wonder-
stepped up basis is a big deal, not just for exchanging. That's its whole tax code to itself.
Yeah,
So there's
yeah.
a lot more to it, certainly. And everybody's tax situation is different. So we always want people, I can give you the suggestion and say, I think this would work this way, but I always want them to go back to their tax and financial advisors
Sure.
and run the numbers and make
Absolutely.
sure people have different types of estate planning set up and things that may or may not
It's a
be
good
right
tip.
for that. But it's a great thing to think about and to try to strategize for. And clients love it when they hear that. They want to go back and talk to their tax advisors because that's, you've
Why
worked
not,
so
right?
hard for
Yeah,
this money.
exactly.
You want someone in your family to appreciate it
Absolutely.
down the road, right?
Yeah.
Absolutely.
Yeah.
Absolutely.
Yeah.
That's what I said. That 1031 exchange is such a great gift for real estate investors. Probably the best one that for
Yes.
tax benefit. Yeah, and I was looking at there's some news talking about the president had a new proposal for limit the maximum value to do 1030 exchange to 500,000.
Yes.
Or they were thinking about getting rid of it even, which is really
Bad.
shame. Yeah, exactly. It's
Bad.
a shame. I mean,
That's where the lobbying dollars come in handy.
Yes.
Yeah.
Yeah. I mean, I think depends on who's in office. We've been up and down this road before,
Sure.
after for a number of years. And we've worked very hard the last 2 or 3 administrations as an industry to be sure. And 1031 industry is pretty small. It's not that big. But we have had some great power and great conversations. We've spoken with House Ways and Means and Senate Finance groups and tried to explain to them that if 1031 is taken away, there's a great majority of people that would never sell.
Mhm.
And if they don't sell, then what happens? There's no recording fees, tax stamps, money that goes back to cities and states and counties
Right.
for real estate
Exactly.
closings. They don't realize that. And a lot of that, eventually people do wind up paying the tax down the road. So it's when they want to try to take something away, it's like a pay for. They want to say, oh, if we take away the exchanges, we'll get all these billions of dollars. And what they don't realize is we've done some studies with Ernst & Young and some others. The majority of people who do a 1031 exchange are not wealthy. They're middle class America. They do it to supplement their own income.
Sure.
They do it save money for college and retirement. And we've definitely, although it's not public knowledge, the exchanges itself, we've been able to show them that it really is a valuable tool, and it helps with infrastructure and it helps with
Bigger
all these
good,
things
yeah, like
for
housing.
the local economy.
exactly. Yeah, local economy.
And a lot of large groups are in support. So AARP, the Farmers Bureau, obviously the tax and legal groups, of NAR, National Association of Realtors, has been a
Yes.
big sponsor and
Yeah.
proponent
Yeah.
of 1031.
Sure.
We have probably about 22 groups,
Right.
and it's been wonderful. And I think they realize that it is a benefit to the taxpayers as a whole across the country.
Great.
Yep.
Well, Patty,
Fingers crossed.
this has been excellent. This has been
Thank
very
you so much for
educational.
having me.
Yeah, no, this has been very informative, and I think
If people want to get in touch with you, we're gonna provide your contact
Oh,
information.
thank you.
below.
Yes,
I really
yep.
appreciate it. And also voice out. I know they can get a link from your website, how they're going to speak to the Congress to keep these programs going.
Yes, actually, we have like a hashtag Save 1031 that you can use even.
That's sweet.
We're very good.
Yeah.
But yes, so you can go to the IPX 1031 website and find my information. You can send a note or anything. Happy to answer questions, even if you're thinking about it for the future. I'm happy to help.
Excellent. Well,
Yeah.
Thank you
Thank
very
you.
much again. and
Thank you all. Thank
for
you all.
joining us, and have a great day.
Thank you.
Thank you. Bye-bye.
Bye bye.